Well, Matt, let's jump into the Yardi Matrix report, the National Multifamily Report, and we feature these quite a bit. They really do a nice job of putting these together. And I am noticing, Matt, Indianapolis is not on the cover image. That means Indianapolis has lost the spot for top rent growth, which is not surprising. Because following a little more granular can only be on top for so long.
Sorry, give us the spotlight. That's fine.
Yeah, exactly.
Yeah, top line numbers, year-over-year rent growth is at 1.8%, and month-over-month is at 0.4%, which is well in line, actually, from the reporting from other organizations. I was crunching the numbers last night, and we follow a number of rent growth trackers, and the average month-over-month rent growth has increased each consecutive month of 2023, but it's still just not at the level as it typically is. Top markets for year-over-year rent growth, I'll kind of give the top four here, is New Jersey, New York, Indianapolis, and Chicago. These top four are the only markets to beat the 10-year rent growth average of 4.7. Now, that 4.7 is elevated due to the massive rent growth we experienced during the pandemic. So these four markets are doing very well, I think, to beat that boosted number. For more of-the-moment data, the monthly rent growth leaders are New York, Chicago, Columbus, and Boston. Now, Columbus, they've swapped out a few of the markets in Yardi Matrix. So they're including Columbus. I think they've excluded Kansas City. They just shaken up things a little bit. And Columbus is worth noting because it's the third highest in month over month rent growth. And all of them saw about 1% of rent growth from May to June, give or take. For the monthly and yearly figures, the story really continues to be one where big cities on the East Coast are bouncing back, and the yearly figure, where big cities on the East Coast are bouncing back, the Midwest is doing consistently strong, and there is this kind of general region. There's a little bit more regionality than you think. Northeast is doing pretty good.
Yeah.
West is doing pretty good. Some of the Sun Belt not doing great. Miami is still doing,
doing its thing.
Still doing its thing. I did want to note Miami is one of the most interesting things here is their lifestyle asset class. They are the third lowest rent growth. This is for month over month and year over year actually as well.
You think that's like a base effect?
So
like there were already high rents in Miami?
Maybe, but then they're the number one for renters by necessity.
Yeah, that's interesting.
This huge bifurcation of rent growth really suggests that the gap between the high-end apartments and the low-end apartments in Miami is closing.
Well, and again, is that because of demand? They'd already raised rents so much in Miami. They were building new apartments, delivering new apartments at incredibly high rents.
Yeah.
Haven't been delivering as many, and so they're not getting the growth. But at the same time, all those older properties at lower rents are seeing increases.
Now that is like a perfect example of what could happen, or maybe what happens a lot of times when new apartments come in. They're the new ones. They're the nice ones.
Yeah, and what do? If you're a competitor that's maybe not as nice, but sort of close, you're like, that's the new high water mark, and you're like, well, let's just bridge the gap. We're charging $1,000, they're charging $2,000. Well, okay, obviously we can't charge $2,000 for the same unit, but maybe we fix things up a little bit, make it a little bit nicer, and we charge $1,500. Is that value? Is that different? Does that make sense? Are we making the right value proposition? You have to know right where that line is. But it's like you can always narrow the gap because people are always looking for value and a discount, and if nothing else in between, you can find a really nice niche.
Exactly, and that's the challenge. It also illustrates the challenge right now is everyone's clamoring for more affordable apartments, and it's just hard to convince people to build something that is affordable or like workforce housing. These kind of you can't, like the ones that are like maybe built in 1980s. You can't just like magically make that appear. And because all the ones that are newly built are probably going to be the nicer ones. It's just hard. Unless it's maybe like government subsidy, but that's just in a whole nother category. It's a spotty. You can't address that problem as effectively as the market is having a difficult time to address that problem.
Yeah, it's figuring it out.
Yeah.
Looks like on lease renewals are staying really pretty strong. The headline here is transacted rents, renewal rates resist slowdown. So we're seeing still some pretty strong renewal figures. I mean, if you'll remember, prior to COVID, the average renewal rate or retention rate in the U.S. was around 50%. And people kind of were staying put longer, and so that pushed up closer to 60%. And in many markets, we're still in the high 50s, 60% range. I mean, Miami, Matt, it's 70%, which is incredible. But people are still, staying put. And for a while, it was because, if you rented somewhere else, that you were going to get hit with full market and the rent was up a lot more. And so they want to save some money staying put. But, as the market has gotten a little less tight and there's been a little bit more favor to the renter and a little bit more, negotiating power, and there's been some more concessions, anecdotally, I would think that this number would start to really go down, which is why, they're saying, it's resisting the slowdown. Still, rates are up pretty well over the long-term average.
Yeah. I mean, it said, what is it? New Jersey, I guess, at 82.3% had the highest renewal rate, reflecting the lack of available options as occupancy rates are above 97%.
Yeah. Not going to move. There's nowhere to go.
Yeah. And another thing worth noting, and I may have noted this earlier, is they have 95% for occupancy. It's fairly steady. It's still, it's not as high as it was, but it is not, it's been steadily falling down since that high for so long that to see this kind of steady, that's nice.
Yeah.
Again, smooth is good.
Smooth is good. No, we would like to be able to predict things. They're also noting here on the report, Matt, supply and demand demographics. Borrowers issue high cost mortgages. Did I pronounce that correctly?
Yeah,
Shoe. Cost of debt has jumped significantly since the spring of 2022 when the Fed started increasing policy rates. Lenders, including Fannie and Freddie, have seen mortgage volumes plunge as a result of a wide market bid-ask spread. Sound familiar? And then more borrowers prefer 5-year fixed-rate loans that can be prepaid after 3 years to provide flexibility when rates are expected to decline.
Hey,
makes sense.
Hey, here's a real risk. You want to get a floating rate now, just ride them on the way while it gets lower.
Don't tempt us, Matt. No, it's a serious argument. I'll give you an example of a deal we're looking at. Our conclusion was the best execution for this deal would be a bridge loan. Now, I think it's like surprising people hear me saying that because we're talking about the kind of the danger of bridge loans over the last year. But we used to use bridge loans all the time, and they can be an excellent tool. Just like any tool, you can use it for good, bad purposes, dangerous, positive, whatever. And the specifics on this deal is it was coming out of a like a decontrol, which the rents, it was an affordable property that had lost its affordability, where it had been transitioned out of affordability. Now it's market rate, but the rents were still all at the affordable rents. And so, you're only getting your loan proceeds based on what the actual, the receipts are, what the actual income is of that property. Now, that, you can cycle through those leases and get those rents up in probably a year or two. But, the loan proceeds that you'd be able to get today based on the current income, because, lending now is all income restricted, debt service coverage ratio restricted, not loan to value or LTV restrictions. It used to be, it's like, whatever the value, you can borrow up to 75%. Now it's like, no, you need to make sure we're clearing this 1.25.
Okay, so it's not
DSCR.
They look at how much money you're bringing in, or how much the value is, and they kind of have that. It's their prerogative.
Yeah, it's usually most things must be true. The loan must not exceed. It basically will have a max LTV, and so that you can go up to this max loan to value, but it also has to meet this debt service coverage ratio requirement. So you still need to be making 25% over just the minimum to cover the debt service.
Yeah.
And then if you're doing that, then we'll lend up to whatever, we hit this max loan to value. And so like in the past, a lot of operators and buyers were, borrowing at around 75% loan to value, not a problem. You can clear your DSCR. Maybe you clear your DSCR at 1.26 or 1.3 or, whatever it was. And, that's what your loan proceeds were based on, your leverage, and also it's all risk, the higher leverage, the bank will give you different terms whether you have lower leverage. So if you have lower leverage, typically they'll give you a little bit of better spread. They give you more years of interest only. So there's a couple differences between kind of where you fall in that risk spectrum when it comes to the your lender and what they'll give you. And so it's been DSCR constrained rather than loan to value.
Yeah. That's what the banks in general are really looking at, that DSCR.
They always are. They always have. They always have been, but it's been the issue now. Because so you'd say, be like, all right, we're buying it for this price. Put a 75%. You used to be able to just kind of assume. You wouldn't. I mean, it wouldn't be difficult to hit the DSCR because we were buying it reasonable cap rates.
There you go.
But now everyone's buying at low cap rates. That makes it difficult to hit that DSCR. And this is where there's going to be some business plans that aren't going to be doing that well because we know just the growth that you had to assume. Everyone was buying at these low cap rates.
Yeah.
Or almost everybody. I think, we were some of the few that really, we drew a line in the sand and said no negative leverage. Other groups did the same thing, but we were in the minority. And, you hear this all the time. It's a bit like, we create the positive leverage because we're going to raise rents. We're going to execute our business plan.
Yeah.
And that's definitely the case. Like we wouldn't be in business if we were just going to buy it and leave it and not do anything. You always want to improve. The way you get a higher rate of return is not just by, assuming that the asset is going to appreciate, but we're going to force appreciation by increasing net operating income, either by raising the income or reducing expenses, or ideally both.
But if I'm a banker, that sounds a lot like promises. Yeah,
well, that's
okay. You can tell me.
And some lenders will lend to you based on your pro forma, especially kind of in the bridge space or debt fund space. They have more flexibility. But if you go to any of the agencies, it's based on what you're collecting. What your T3 says, what your T12 says.
Like not just what you're expecting, but what.
No, I mean you have to prove it out, especially now. I mean, again, we've talked about this week after week. It's credit is not loosening.
Yeah,
credit is tightening, and so these banks want to make sure that the loans that they are issuing are good loans, good borrowers, and not just It's not business as it was in 2021.
Yeah, which is interesting. So I wonder, is there like an opening here? Because they talk about how the low volume for Fannie and Freddie means that they're missing their target for how much they need to lend.
Yeah.
And does that mean that there are some people that could get like a deal, or that they will make an arrangement in order to meet the target?
I believe we'll have to confirm this. I've been told that Fannie and Freddie have been told that don't worry as much about your quotas or your caps because the concern is always that if they don't lend if they miss those, they'll get their quotas, the caps reduced. They won't have as much to borrow to lend. Sorry.
Yeah.
If you remember, I think it was back in 2019. Fannie and Freddie were at those caps. They ran into those caps.
Yeah.
They didn't have any more money to lend. And spreads blew out. It was really frustrating. People had to look at alternative, financing measures. It wasn't a long period of time. We have the opposite problem now, where they had the caps increased where they can lend, and I forget what the caps are for 2023. But they're not
$75 billion or something.
Okay, that sounds about right. That's about what I think. Because it was increased to $70 billion a piece a couple years ago. Yeah, Fannie Mae and Freddie Mac won't meet allocations. Now it's $75 billion again. I believe that's a piece. If rates remain at 6.25 to 6.5, I don't see us getting to $75 billion. Not even close. One GSE executive said at the recent CRE Finance Council annual conference, without transaction activity, it's hard to see volumes get anywhere near $70 billion. Along those lines, the agencies changed the production mandate for mission-driven, affordable, and green loans to half of originations as opposed to a specific number of units. So that means, again, green emission, there's a environmental component, making properties more efficient, low flows, LEDs. Mission is, targeting, the moderate income band. I forget what percentage of AMI, but, not super luxury. You're providing housing that's kind of, again, close to that median income range. And if you fall in that category, again, it's not like subsidized, it's not like affordable housing. If you're providing housing to a certain income range that the current rents are, you can get some better loan terms, such as maybe a 35-year amortization if the agencies are still providing that. I've gotten mixed messaging that they are slowing that down. Then I'm also hearing that if it's a true mission deal, they will still be open to it. But then also interest only in your spread, again, of green or mission, they can get a little bit better on their spread. A spread is like the profit, the interest they're going to charge over the base rate. So, typically people are borrowing either, on a 5, 7, 10-year term. So the loan is based on the 5, 7, 10-year treasury plus a certain spread that the lender is trying to make over that, account for their risk. So like right now it's kind of, mid 200, call it 220 to 280 spread, 300 point spread right now. And so, but they've got some flexibility with that spread. And that's where you're asking Matt of like, hey, they make it desperate. So people get a deal. The deal would come in the spread.
Okay.
Maybe the amortization, maybe the IO, but the spread is really where they can help. If it goes from 250 to 280, well, that's, that's 0.3%, of your rate that goes down. That can be meaningful because when your rate goes down, that affects your debt service coverage ratio. Less debt service that you have to pay. Therefore, you can get a better ratio, which means you can get more proceeds, which then, more proceeds is more debt service. But, so it's a little bit of a, cyclical chicken and the egg, but the better that you do, the more proceeds, better loan value.
I don't run the Excel things, but it's crazy how much the numbers go up if you change a small amount of the debt.
Yeah. We've got other people to run the Excel things.
Yes, gratefully, thankfully so.
Yeah. All right. Just real quick, Megan, employment and supply trends. Again, this is looking into the future. Let's see where things are going. Maybe, look at some acquisition targets.
It doesn't seem like much has changed specifically, but I did want to pull out Indianapolis has a great, as great prospects, really great rent growth, really pretty decent job growth, really promising for investors, completions as a percentage of total. So not a whole lot of supply coming online. And then in the next page, you look at the income to rent to income levels, or I'm sorry, it may have been the either way. It's really cheap to live in Indianapolis. There's not a lot of apartments coming online, and there's really just all of these factors are support the idea that
they don't have rent income ratios.
Oh no, it was the page before.
Sorry. I'll find it for everybody just so they can look at it. But yeah, no, I mean, Matt, we talk. I mean, we don't need. People have heard us talk about why we like Indianapolis a lot, but I mean, you don't have that much supply coming online, but the rents are growing, the jobs are growing, and it's still affordable, which means that there is room to grow. I mean, of this major market list of, what percentage of your income is going to rent, New York tops the list. I mean, renters by necessity are paying, Matt, 44%. I mean, it's horrible. Rent control seems like it's really working out for the Empire State, or the Big Apple. San Diego, same story, 38% renters by necessity. I mean, that's just a travesty. It's too bad. LA, I mean, horrible. But go down to the bottom of the list. I mean, you've got Indianapolis. It's surprising to see Austin there as well. But I mean, Indianapolis, for renters by necessity, 27%. That could ideally be even lower. Anything over 30% is considered rent burdened. But it's a market that it's not rent burdened. Most of these other markets are in the 30s.
Yeah.
But then if you are, lifestyle units, more expensive stuff, it's 25% for Indianapolis. Overall, 26% income to rent ratio, which is, again, pretty darn good. And again, one of the reasons why people are moving around is affordability.